has the opposite definition. Anything that has a lifetime in the corporation longer than a year, then the value of that asset is long-term asset. So typically when you purchase a piece of land, it can be used for multiple years. Usually company do not just purchase it and sell it immediately. Okay, so land, building, furniture, equipment, we're talking about the business that don't use these long-term assets as a way to generate revenue. So really these are the long-term assets for them just to support their business operations. Okay, so if you're talking about like an equipment company, then that's a different story. Then equipment is considered inventory. So here we're talking about long-term assets that's there to support daily business operations. You need a physical place, you need a warehouse, you need a store, rented place for you to hold all the inventory for customer to come to purchase. You need furniture to support the office facilities, have equipment to help you lift some of the products. So all the values the cash amount, the value that these long-term assets holds will be listed under long-term asset category because it has a lifetime in the business for longer than a year. And if you link this to Chapter 3, remember long-term asset besides land, all the others we have to depreciate its value. Okay, the reason why we depreciate it is because it's there in the business for a longer period of time. We don't want to misrepresent the value of the asset. Okay, so as we use the asset, we will depreciate long-term assets value, typically spreading the cost along the years. Okay, just so that the creditors or shareholders, when they look at financial statements, they know that although this asset is there in your business, but after 10 years of usage, it's no longer, it doesn't have the same value as when you just purchase it in. So we usually depreciate it as time goes by, reduce the cost, reduce the usefulness, the value of those assets. But land is an exception. We don't depreciate land. Okay? All the other assets you see here, some of them will be introducing it to you later on throughout the semester. So don't worry too much about long-term investment listed in the textbook. So it'll be introduced to you later in Chapter 10 and 11. Now, don't forget count in Chapter 3. Accumulated depreciation always is listed right underneath furniture or right underneath building as we depreciate it. It is also considered a long-term asset account. Okay, it is always represented right below those long-term assets.
Can you show if the land price is down compared to like when you bought it? Like the house price was down, the value was down.
We only would consider that whenever the company wants to sell the piece of land. At that time point, when they're able to set a price with whoever is purchasing it, then that will be the time when we capture land's value at that time point. But over time in accounting, we'll just have the land's value there as the same value when we purchased it before. Okay, so I think mainly because there's no real prediction in terms of it really depends on the area, right? So some areas you may have it prospering and the land prices goes up. Some areas may go down. So that in accounting, we prefer to have a historical value there, but we will definitely capture that if the company decides to sell it out. So that will be the time to capture the differences. Okay? But yes, so very good question. So other assets, that is the only one that we have the historical value there until we sell it out. Then we change it and determine whether there's additional revenue earned by that, trading those assets. Otherwise, all the other ones, we have depreciation accounts underneath it. Specifically, accumulated depreciation. Okay, so this is also a long-term asset account. All right, for liabilities, same definition.